Affordability is a big deal right now in the market. Home prices are up, interest rates are up. Boy, it's getting hard for our clients to find a monthly payment that fits their budget. I'm going to share with you today some ideas on how you can get a rate in the threes, and these are pretty cool. My name's Miles Pitcher. I'm the owner of Superior Lending. I've been in the business for 21 years now. So here's a chart of what it looks like on interest rates over, since back into the 70s. And you can see in this shaded green area, this was the time period when we had the rates in the twos and the threes. It was phenomenal. It was a killer rate, but we can't go back in time. However, there are some ways that I can help you possibly get a rate back into the threes or a lower rate. So let's jump through a few of these. The last ones are my favorite and the most viable, in my opinion, but we'll get started. Oh, first, if you find this video helpful at all, hit that like button for me. It helps make it so that this video will show up in other people's feeds as being a really solid video for them. All right, first is a permanent buy down. This is oftentimes called buying discount points or paying points to buy down the rate. It is crazy expensive to do it if you're trying to get all the way down into the threes. It is an option. Uh, I often get asked, hey, how much does it cost to buy down an eighth in the interest rate? There is no perfect formula on calculating how far to buy down the rate. It is not a perfect linear line. You have to just really look case by case, but typically I don't encourage my clients to pay points. The only reason why that we do it is that my client believes that interest rates are going to go up in the future. And so this is a really good way to get a permanent buy down. Also, um, it yeah, it's just expensive. We always measure the break even. And by the way, I have a whole video on this subject and these other options in the comments section below or in the description. I'll link to these videos that go more into depth at looking at this and evaluating, should I be paying points or not? But it's an option. Uh, it also helps you if you're having troubles qualifying for a higher loan amount or a higher purchase price. This is good because once you buy points, that becomes your qualifying interest rate. The next is adjustable rate mortgages. And these oftentimes have good pricing, oftentimes they stink. Right now, they're not that great, but they're worth checking into. What an adjustable rate mortgage is it's a 30-year mortgage. There's a fixed period, and that can be 3 years, 5 years, 7 years, or 10 years. Once that intro or fixed period is done, then the loan becomes an adjustable rate mortgage. It becomes variable. You can refi during your fixed rate period, and that's usually what I plan with my clients is saying, hey, let's plan on you being in this home and having 7 years of a fixed period. During that time, we know we need to watch for the opportunity to refinance you and get you out of this adjustable rate back into a fixed 30-year mortgage. Some of the pros of it does give you a lower intro rate. It typically is a longer fixed period, so you have more protection than a temporary buy down, and I'll talk to you about that next. The cons here is that you don't know what the market condition will be in the future. Will there be an opportunity to refi? Will your income and your job allow you, your credit score allow you to refi when at that same time? And will the home value support the refinance at the time you need to do that? So always make sure that you ask the loan officer, what is my worst case scenario? Because there is a maximum or capped rate on these adjustable rate mortgages. You need to know what your worst case scenario is if for some reason you're unable to refinance out of the adjustable rate. Again, there are full length videos I'll link to that you can watch and dive into that if you want to check out those options. This is one of the hottest products right now that we're doing as a temporary buy down. And a lot of people have heard of these. The 2-1 buy down is probably the most popular. I want to make sure you're aware of the 3-2-1. And by the way, on a temporary buy down, you can do these on jumbo loans, conventional loans, FHA, VA, and USDA. For example, FHA allows for a 2-1 buy down, but they don't have a 3-2-1 buy down. But conventional, we can. And I want to show you what this looks like. So what this means is a 3-2-1 means that in year one, so your first year of making monthly payments, your interest rate or your payments are based on a 3% lower rate from the permanent rate. Year two is 2% lower. Year three is 1% lower. And then year four through the rest of the loan, through the rest of the 30 years, is at your permanent rate. Let me show you what that means. So just using an example rate of a permanent rate of 6.75, year one would be at 3.75 or 3% lower, 4.75, then 5.75, and then back to the permanent rate. The beauty of this is that you really get to ease into this. It gives you some payment relief there. You can refinance at any time. One of the keys here is that you have to have the seller. You don't have to, but it works best if you get the seller or builder to cover the cost of the buy down. And it works really well that way. Here's the cons to it is, again, you don't know what future market conditions will be like, meaning you do want to look for an opportunity to refinance. Will the home value support that? Will your credit, your income all support that? If yes, then this is a great option. The other part of this is that you have to qualify for this loan at the permanent rate. So if you're really tight on your debt ratios, this may or may not fit. If you are tight, you then would look at a permanent buy down. But super cool. Watch the video that goes a deep dive into this. It'll help you understand it a little bit better. All right, our last one that I really love. If it fits for you, this is phenomenal. So most people don't realize that if you're doing an owner-occupied loan and you qualify, you can assume an FHA or a VA loan, these government loans. You have to owner occupy it. You have to go to the current so if you have a seller that has an FHA loan, you have to work through that seller and the servicer of their loan. And you do a full qualification with them. You apply, they look at your debt ratios, they look at your credit scores, and they will approve you to take over and assume that loan. At that point, the seller is released off of the obligation on the mortgage, and you get to take over their mortgage. So if they're 2 years into their mortgage, 2, 3 years, you get to pick up right where they're at on their mortgage, and you get to take their beautiful 2-3% interest rate that they have on this home. It's really, really cool. As a loan officer, I don't help you do that. I'm not involved in that. You're working again with the servicer of the current loan. Most people will, not most people, a lot of people will advertise when they're selling their home that the loan is assumable. Make sure you're working with a real estate agent that knows about these so that they can ask the sellers, hey, by the way, do you have an FHA loan, VA loan? Are you open to our clients assuming it? The big one that you have to deal with, and this is the biggest hurdle in this, is that let's say that you're buying the home for 400,000, the loan balance is at 300,000. You have to figure out how to cover that gap, right? Because when you assume the loan, you're taking over the current loan balance at 300,000. So you have $100,000 gap. You either have to bring that in yourself or get some type of a second loan. And that's where we can help clients come in with a second position home equity line of credit or fixed second to close that gap. You will have to come in with some money down because there is a minimum down payment, but that typically is the biggest hurdle. If you have those funds to cover that equity gap, boy, you're in business. It's a great way to go. The rates are incredible. The cons to this are that there is an equity gap. You have to deal with the servicer. They're not the fastest. They can be painful. The servicing companies are really, really good at servicing loans, but they're not really good at generally at underwriting you as a new buyer or taking over this loan and dealing with all that. So just be prepared. We have seen and had a few clients who have been successful in this, and it's worked out great for them. Here's how you can get a hold of me if you have any questions about any of these options. Always happy to help answer questions. We do have the ability to do loans in all 50 states. Give me a call. Let me know. Have a good one. Thanks.